Hello friends, welcome to my YouTube channel Tech with Imran 013. I hope you all are fine. The topic of this video is what is a mortgage? A mortgage is a type of loan secured by real property. Most people think of a mortgage as being drawn to purchase a property, but mortgage loans are also used to refinance properties that are already owned by the borrower. A mortgage drawn to support the acquisition or the refinancing of a home is typically called a residential mortgage. A mortgage drawn to support the acquisition or the refinancing of a commercially zoned property like a warehouse, mall, or office facility is usually called a commercial mortgage. A mortgage lender creditor is compensated for extending the credit by charging the borrower debtor interest. Key highlights: a mortgage is a type of loan secured by real property. There are both residential and commercial mortgages with risk characteristics that are unique to each. Mortgages tend to have more favorable terms, longer amortization, higher LTV, and lower interest rates than other types of borrowing. Mortgage loans are made by traditional banks as well as other financial services, firms like insurance companies, asset managers, and other investment funds. How does a mortgage work? Let's us a residential mortgage example for a personal borrower who approaches their bank to purchase a home. Say the home cost $2 lakh and they are required to put in a 5% down payment. This means $10,000 down payment, $1,90,000 mortgage. This represents a 95% loan to value. The bank will register a line, sometimes called a security charge, over the property for the full amount of credit outstanding. In this case, $1,90,000. This security registration makes the property collateral for the mortgage loan, but the buyer never actually receives cash from their bank. As noted in the diagram below, they send the down payment to the financial institution, which in turn facilitates the home purchase. They do so by advancing funds on the borrower's behalf and working with the various legal representatives to ensure that title of the property is correctly transferred from the vendor to the buyer. The line is correctly registered on behalf of the buyer's bank, and the seller receives their funds by way of their own financial institution. Over the course of the mortgage's amortization period, the borrower will then pay the $1,90,000 back plus interest. Mortgages residential versus commercial. Both residential and commercial mortgages share some common characteristics, including that lenders take property as collateral, they generally require an appraisal, and both typically have a more favorable loan structure than other types of credit. But there are also some important differences that make them unique. Residential mortgages. Some key characteristics include: the property is often occupied by the borrower, meaning it's their primary residence. The borrower is typically an individual or a married couple. The borrowers is usually servicing the mortgages with their personal earnings and must therefore be able to prove they have a stable income, provide evidence of any other valuable outside assets, and demonstrate a good credit history. Residential properties tend to have very active secondary markets and therefore generally support higher LTVs, loan to values often up to 95%. I hope you all like this video. For more informative video, please like, share and subscribe to my YouTube channel Tech with Imran 013.